Saurabh, hi, good morning. Good to have you on the show. Saurabh, finally, as you wrote in your note as well, policymakers have acknowledged the consumption slowdown and they're doing whatever it takes to try and propel consumption. When is it that you actually see a meaningful recovery on ground?
I think, to be fair, Aisha, I think Q3, the quarter to December, it's already looking fairly perked up. So whether it is consumer durables, whether it is auto, whether it is FMCG, October clearly was spectacular. I think November is turning out to be a little bit more moderated, but my reading is the quarter to December will be the best quarter for earnings growth for the Nifty in nearly 2.5 years. So the quarter to September Nifty earnings grew at a pretty weak 1%. My reading is the quarter to December Nifty earnings will approach the sort of magical 10% mark. And I think that's as good as you can expect from policymakers in one quarter. The big test, I think, will be 2026, right? So it's good to hear the RBI governor indicating further rate cuts ahead. I think another 100 bips of rate cuts is required to give relief to the middle class in what is clearly a very tricky situation of the middle class. Lots of debt, a tight job market. And then hopefully in the budget, we'll see more tax cuts, direct tax cuts aimed at the middle class. And I think that's how we can get this economy back on track. By giving the middle class relief, both through interest rate cuts and by tax cuts.
Interesting. But Saurabh, is it going to come at the cost of Capex slowdown, this thrust on consumption? I mean, we've been debating about that internally, whether that's going to be the case.
It'll have to be, Aisha. I think there's only so much money to go around. And it's relatively clear that the whole supply chain that supplies government Capex really can't do that much more than 10 trillion. So leaving aside how much money the government has, even from a capacity perspective, I don't think we can do more than 10 trillion rupees of government Capex. And since the budgeted numbers for the current fiscal are, I think, 11 or 12, I forget whether it's 11 or 12. As it is, we've crossed the 10 trillion mark. I think India would do well to come back below the 10 trillion mark and turn those monies towards giving relief to the middle class, because consumption is 60% of GDP, right? The 40 million taxpayers, the 40 million income taxpayers are the core engine of consumption in our country. And they've basically been hammered over the last 5-6 years with lots of both income taxes. Income tax burden as a percentage of GDP went from 2.5 to 3.8% a year ago, and GST had climbed up. So it's great to see that the clock is being turned back. We've had income tax relief in the current fiscal, GST relief in the current fiscal, and rate cuts in the current fiscal. I think we need a repeat dose of that through 2026 to get the whole consumption story and the Nifty earnings growth story back on track.
Saurabh, with nominal GDP growth expected to be below 10%, do you think the government has enough room for another direct tax cut and maintain the fiscal target as well?
I think, as we discussed, right, it's a clear offset. You throttle off on Capex, and if you throttle off 2 trillion rupees out of the 10 trillion or 11 trillion that's currently budgeted, if you throttle off 2 trillion, you've got enough room there to take the zero income tax band, which is currently up to 12 lakhs. Remember the 1st February 2025 budget, the FM said they're up to 12 lakhs. There's no income tax. I think that number, rather than being 12 lakhs, if it's lifted to 15 lakhs, it'll cost the exchequer around 2 lakh crores. And I think that can come from cutting government Capex.
Saurabh, you've been bullish on consumption. One of the stocks that you're bullish on is Trent as well. What's happening in that counter? I mean, even though it has corrected a lot, it's still at a high valuation.
Right, so I think, as you're alluding to, the broad-based slowdown in consumption is hitting everybody, including Trent. What I find interesting is more than any of the other large apparel players, right? So more than, for example, Reliance Retail or Aditya Birla Fashion Retail, Trent has been able to keep the same store sales growth numbers at a punchy level, albeit even for Trent, SSG has come off. And like everybody else, if the government carries on doing what they've done so effectively over the last 3 months, if the exchequer carries on doing what they've done so effectively through August, September, October, Trend too will be a beneficiary. Our math suggests that the PE multiple is not the right way to look at Trent. If you cut through the adjustments that you need to make to earnings to factor in the rapid store expansion, Trent's trading at a reasonably sensible PE. As I think, as you're also alluding to, the stock is off 40 or 45% from its all-time highs. So we are very comfortably placed with a big position in Trent. And I'm hoping that we get more of what we have seen through October, November, December. If we see that through 2026, I'm confident that amongst others, Trent will benefit from that.
You're penciling in a better Q3 earnings growth for the Nifty companies. What about if you look outside the Nifty companies to a broader basket of say 100, 150 companies there? Do you see consumption growth coming in in other sectors as well, in terms of consumer durables or discretionary spend?
Sure. So let's just get into that. The broader earnings picture is slightly better. So for the quarter to September, BSE 500 and SE 500 earnings growth, I think, was around the 10% mark. And if consumption picks up further through 2026, even the broader earnings picture should improve. What I found remarkable was how moderated, how sober Nifty EPS growth had been for 2.5 years. And that's why the 1% figure for the quarter to September, I think that's going to improve sharply for the quarter to December. But yes, even in the broader market, given that consumption is the majority of our economy, if consumption improves, there'll be cheer all around on the earnings picture for the whole market.
Right. Saurabh, just coming back to your view on Trent, the kind of valuation correction that we've seen for Trent, and the stock price has almost halved in the recent times. What do you think is leading to this valuation correction? Because the value proposition still exists for a stock like Trent. Why then have we seen such sharp value correction?
It's the same story. So earnings slowed down. Consumption slowed down for the whole country. And Trent's SSG was, I think, high teens 6 or 7 quarters ago. And this quarter Trent's same-store sales growth was in high single digits. So it's a pretty meaningful slowdown in same-store sales growth, which has led to the stock coming off by 40-45%. But as I said, right, it's a broad-based consumption slowdown, and we are seeing very encouraging policy action, which suggests that the government is seized of the gravity of the situation and is making the necessary fiscal adjustments. In parallel, the RBI seems to be making the necessary monetary adjustments to get consumption back on track. And if we get consumption back on track as a nation next year, I think Trent will be a big beneficiary of that, because in that space, value apparel space, it's clearly head and shoulders above the competition.
Right. So let's talk about the new labor laws. And again, that also is a thrust to consumption, right? Which sector do you think would be a direct beneficiary, purely looking at it from an investment angle?
So, I was looking at the new labor laws and I spoke to a whole bunch of promoters yesterday. It's not evident to me there's some great relief that will be, available to companies. It is slightly easier to fire people now. So companies all the way up to 300, I think workers don't need government permission. But most employers I spoke to yesterday that said that their costs go up by 12%. Roughly the figure I heard was 12% increase in payroll costs for the various new impositions that the new labor laws impose on employers. So it's not evident to me that this labor law reform will be an immediate trigger for earnings revival or for business sentiment revival. For that, I think for business sentiment to revive, for private Capex to improve further, private Capex seems to have improved a touch over the last 6 months. For that to improve further, we need more stellar weeks like those memorable weeks that we had approaching Diwali this year.
Saurabh, on the same point, do you see a wage inflation coming in? Because in some of the sectors which are labor intensive, like real estate construction or any other infra projects there?
So it might come in, but I'm not so sure that's going to be a big issue, because in our country, right, whether it is real estate, whether it is road building, every factory that I visit, everything has been so rapidly automated and mechanized that wages as a percentage of total cost has actually gone down across the board over the last decade or so. Most employers in India, whether it be in white-collar jobs or in blue-collar jobs, have heavily automated and replaced labor with capital. And hence wage inflation, I think, is now a secondary concern. As I was saying yesterday, the promoters that I met were mentioning that the new labor laws mean 12% extra. But I could figure out that anyway they were going to replace workers with machines. which is actually a big concern for the country over the next 5 to 10 years, right? We've seen this over the last decade, replacement of workers with machines in factories, even in NHAI road projects, for a typical kilometer of road built, the labor requirement is down by 80% over the last 10 years. And now, as I'm sure as you're hearing, right, AI is coming for office jobs in the tech sector, in the legal sector, in financial services and media. I think this piece, right, the replacement of human beings with machines, first in factories, now in offices, will be India's big structural challenge over the next 3 years or so.
And if you bring in all those things into the tech sector as well, do you see a revenue deflation coming in for many of the IT companies there in that sense?
So paradoxically, the IT companies benefit somewhat because they can do more with less. I think the HCL Tech CEO has been the most blunt on this subject. He's clearly explicitly said that they're basically planning to do 2x as much with half as many people. But more or less, all the IT companies have kicked off programs to replace their workers with AI. In the West, Microsoft and Google have been pretty explicit over the last couple of years that 1/3 of coding is now done by AI. So for the Indian IT companies, in the short run, it's a benefit because they can do more work with less people, and therefore their margin should benefit.
And Saurabh, once again coming to the wages front, the labor code, the new one, it emphasizes a lot on fair wages. But given this, do you believe that India as an economy has a risk of getting stuck as a middle income economy, given that that's a trap where we've seen a lot of countries get stuck economically?
I don't think the labor code should be to blame for that. I think the broader issue, as I'm saying, is we've created a system since 1991 where people like us go to university, study, get a job, get promoted. We consume basis whatever salary and bonus we get, and that consumption drives the economy. That cycle, I think, is at risk because, as we are discussing, right, it's no longer clear that university education actually leads to gainful employment because there are so few jobs to go around. Most companies that we invest in, most companies that we meet are happy replacing human beings with AI in the office and robots in the factory. And that's where I think we face a challenge. Our whole economic construct was around roughly 40 million people getting educated, getting paid well, and driving tax payments and driving the economy. That 40 million middle class is at risk from the technology disruption that is rippling across the world. For the West, AI is a net benefit because they're labor scarce. For us, AI is a threat because we're a labor-rich country which needs to create jobs, but it's now challenged in job creation, courtesy the remarkable advancements in technology over the last 4 years.
Saurabh, if you have a view on the defense stocks, what's your take on them?
No, look, I've never looked at a defense stock in my life. I really wouldn't know about that sector at all.
And why have you stayed out of it? Because it's one of the most
If you
outperforming
invest in a
sector.
company which has one client, very difficult to figure out, very difficult to project revenues and valuations into the future.
Makes sense. But sort of from last budget, when I remember you were sitting with us in the studio and, there was that income tax adjustment. From then to now, what are the consumption names that you've recommended a buy on?
So we've had Trent for many years. In fact, as the stocks come off, we've nudged up our position a little bit. We've had Asian Paints for many years. As the stock came off and people got resolutely negative on Asian Paints, we were absolutely delighted to jack up our position. But leaving those aside, in South India, we've bought Vijay Diagnostics. We've increased our position in Vijay Diagnostics quite meaningfully over the last year. Narayan Hrudyalaya, another healthcare business in South India, we increased the stake in that over the last 12 months. In our small and mid-cap fund, we bought Eris Life Sciences roughly a year ago. I think those are the names off the top of my head. NH and Narayan Hrudyalaya, Vijay Diagnostics, Eris. And you can see the healthcare theme, right? The reason we like healthcare is I think Ayushman Bharat is a very effective scheme. And the government of India is reasonably clearly communicated over the last 2-3 years that the government itself will not provide healthcare. They will provide health insurance. And Ayushman Bharat for low-income people plus Medicare for people like us means that there will be demand for healthcare, hospitals, diagnostics, medicines, and we think we can make money from that.
Saurabh, you do a lot of on-ground surveys. And in the past 1 month and a half, if you have done one, what is the key takeaway from them?
So we haven't gone on the road since Diwali. So I'm holding back because I'm waiting for the euphoria to settle a little bit. So mid-December we'll hit the road again to see whether the euphoria we saw approaching Dhanteras, whether something akin to that is sustaining. I'm hopeful, I'm optimistic that it will. But mid-December to Christmas, we will do a bunch of checks to see how this quarter is ending. As you can make out from my tone, this is the happiest quarter from a consumption perspective after 2.5 years. I'm really optimistic that between 15th to 30th December, as we travel across India again, I'm optimistic that we will encounter, buoyed up, G'd up retailers, distributors, and wholesalers.
Okay, hoping for that. But Saurabh, you did mention Asian Paints, and what a surprisingly strong quarter from Asian Paints this time around with very healthy volume growth. You believe now this growth is here to stay for Asian Paints because it did see a little bit of a blip, but seems like that volume growth, at least for Asian Paints, is coming back.
So look, I mean, it's difficult to second guess, even for us, whether this quarter will be good or the next quarter will be good. What we had said for all these years, whether it is HDFC Bank, whether it is Asian Paints, whether it is Trent, what we keep saying is our job is to identify companies, franchises which are strong, which have competitive advantages, which are stronger than their peers. And if we do that reasonably consistently, we identify strong franchises who have competitive strengths that their rivals simply don't possess, then sooner rather than later, they will pull away from their rivals, right? So when HDFC Bank went through 2.5 years of flat share prices, a lot of people had to go at us, and we stuck to our guns. We built a large position in HDFC Bank, and thankfully it's worked out. And ditto with Asian Paints. Let's hope that 2026 brings a revival in the paint sector. I think if you ask me, my bigger concern is paint volumes are still sclerotic at 1 or 2%. Volume growth for the whole paint industry is the big challenge at the moment. I don't think competition ever was the primary concern. The competitors who came up were for companies in commodity sectors trying their best to enter paint. It was always going to be an uphill task for them. I think the bigger challenge for everybody in the paint sector is this 1 to 2% volume growth, which is actually unheard of in India. It's hard to believe that our country is seeing this quarter after quarter of such low paint volume growth. Let's hope that picture improves on the back of the broader revival in consumption in the country.
So, is there a better way to play consumption via how to consume rather than what to consume? You think consumer tech would be a winner here?
So it can be so. We've been shareholders of InfoEdge now for a fair while, Aisha, and as you know, InfoEdge is driven by Zomato/Eternal and Policy Bazaar from an insurance perspective. So there are tech elements of consumption which are clearly coming to play. The whole Q-commerce disruption is meaningful, and if the Q-com firms start making money, if the Q-commerce firms start making money, then we would have seen a decisive shift in how FMCG and retail intermediation is done. Until that day, until we see profitability in this consumer tech space, we will carry on, doing this conservatively through high quality companies like InfoEdge. But it does look like India is turning the corner. Some of the consumer tech names seem to be on the cusp of making serious amounts of money.
Saurabh, so far so good, and India has really been resilient amidst all the global volatility as well, although it didn't quite move up with the global markets too. But what's the big global red flag or risk factor that you foresee as a headwind?
I mean, look, it's the Trump tariff thing seems to be, for the rest of the world, sans India. For the rest of the world, sans India, the Trump tariff story seems to have settled down. That's I think the good news for the second half of 2026. But the geopolitical tension piece, big countries, major powers going at each other's throats, that piece still seems to be evident. So Japan and China are having a go at each other again. Russia still hasn't made peace with Ukraine. And I think that's the piece which potentially will be the joker in the pack for 2026, right? There's a whole bunch of regional powers who seem to now be flexing their muscles. And which of these fights result in commodity prices soaring? Which of these fights result in global global shipping lanes being disrupted is hard to second guess. I guess we've reached a world where, because America is not as assertive as it was as the world's policeman, is that America is not as assertive as it was as the global hegemon, and China is increasingly equal to America. In this multipolar world, we'll just have to reconcile ourselves to shocks on commodities and freight, global freight, every so often. And as long as we can sort of mentally work with that and create valuation buffers, margin of safety in our valuations, we should be able to deal with it. But the big story, I think, in 2026 will be there's more of these regional fights and punch-ups and conflicts seem to be on the anvil.
Okay, geopolitics, that's the big concern right now, or could turn out to be a concern, if at all. But Saurabh, so great to chat with you today. Thank you for your
Thanks,
time.
Aisha.